as we get settled into the market trade. So metals is leading 2% higher there. Healthcare is well strong today, 2.5%. Ranbaxy is a big mover, so are smaller mid-cap names there like Orchid and Matrix, of course, because of the Mylan decision to complete the acquisition process as well as the delisting at a price of 150 rupees. But let's shift gears and talk about this globally generated rally that we witnessed, a relief rally. We'll not go into details of bull market or bear market, but nonetheless an extremely strong and vociferous relief rally coming in. Our guest is Aaron Smith, Managing Director, Superfund Financial, who joins us from our Singapore studio. Aaron, good to have you on the show with us. Let's talk about your viewpoint on this rally. You've been a significant outperformer in the bear market, so it'll be interesting to really get to know that if your thoughts have changed about the bear market getting over and a bull market resuming, or this rally sustaining itself for far longer now.
Yeah, certainly, Namrata, we have closed our short positions in equities, and we tend to look at the market now in sort of retracement mode. I would say that this rally could last through the G20 summit. But it's important for investors to realize that this rally is artificially fueled by government spending. If you add up all the bailouts and government programs from the past year in the United States, it totals about $13 trillion. Today, the market cap of India is like $50 billion. So that kind of spending is just unprecedented and has to have an effect on the market. If you just consider the amount that will come through with the G20 summit, we expect this could possibly continue. However, I would emphasize this is an artificially inseminated rally. I think that in the short run you can make profits long in stocks, but we have not seen enough of an uptrend to where, as a trend follower, we would start to take long positions at this point. We would be very cautious about equities, and the real money will be made in the next 2 to 3 years in commodities, in metals like gold and silver, real estate, and possibly some alternative investments like managed futures funds.
Aaron, so the point that my colleague made, what is your feeling from where the equity market per se goes from here? You think it's getting overbought for the near to medium term for people to get in at these levels, sell at every rally, that sort of a thing, or you think there is more to come, quality notwithstanding?
I think the rally will continue just long enough for the retail investors to start to get into the market. And so you look maybe 15, 20, 25% higher from here across the board. And then at that point, I think it'll start to correct and go back into a downward trend. If you look in the overall market, if you look at 150-day moving average, the downtrend is still intact. This is what we think of as a bear market rally. Certainly it's enough to where we would have closed our short positions in equities, but at the same time we certainly haven't gone long yet. So if you're sort of adventurous, yeah, maybe you can make money out of a short-term gains in this bull market rally, but I think this will be short-lived.
Aaron, regarding India and maybe other EMs, if you can talk about that, because so far everything seems to be moving in one trend. I know within Asia, the markets like Shanghai, which are outperforming other markets, Nikkei, of course, is just about flat on a YTD basis, down actually about 0.5%. But do you believe that India could be one of the outperformers and gain more leverage from here on?
In the very, very long term, when the financial crisis has worked itself out, India will be one of the top performers. But that's a big question as to when that day will come. In the meantime, the correlation of global markets is so high, and the amount of negative information coming out, 500,000 people a month losing their jobs in the United States, over 250,000 people in the financial sector fired in London and New York. The ramifications are going to last for possibly years. And that's going to have an impact on all the EMs, including India, in the short run. And if you look at the institutional money flows, they go hand in hand. So I think that, unfortunately, equity markets are going to be volatile and very difficult place for anyone other than certainly short-term traders to make profits. But I would not look for the huge upward bull market trends that we saw pre-2007 in India. I think that that's going to be further out on the horizon. Much better strategy is to look at real assets. We advocate commodities. We like oil at these levels, very cheap. Silver and gold, certainly we think are actually cheap at these levels, especially silver. And real estate, possibly looking at managed futures funds as well. This is really the mix that's going to bring success over the next 2 to 3 years. Equities, if we haven't learned anything, we should learn the fact that equities are dangerous. I would say organized form of gambling, or a sophisticated form of gambling, in my opinion.
Aaron,